Hey everybody, welcome back to Drawbridge Finance. My name's Levi, and today I'm going to give you guys a look into my personal portfolio so we can look at what options are expiring today. Well, I can't believe it's been another month already, but today is the day, Friday, June 15th, when my monthly option contracts are going to expire. So it's 11:30 here Pacific Standard Time, which means I'm about an hour and a half away from the close of the week, which means that my monthly options are going to expire on the close in about an hour and a half. So I'm just going to take a quick look at my portfolio and just make sure as we go into the end of the day that all of my contracts are well out of the money and they're all going to expire worthless. Let's take a look. I filtered this so we're only looking at options that are expiring today, June 15th. Now, the first thing I want you to notice is that I have short sold all of these. I am negative all of them. In order for me to close these positions, I either have to buy them out, so I have to buy them for whatever the price is now, or I have to let them expire. If they expire, that negative value is going to become zero on Monday. So what I need to make sure is that the current price of the stock is on the right side of the strike price. So in a put, if I have short sold a put, I want the current price of the stock to be above the strike price. If I have short sold a call, I want the current price of the stock to be below the strike price of the call. Let's just take a look at the columns. If we look at Apple, I have negative one put at $180. What this means is that Apple needs to be trading above $180. Let's take a look at the current price. If I click on trade, it'll bring this up, and it says the last price was $189. So at $189, that is $9 out of the money. I don't think that Apple is going to drop $9 in the next hour and a half. So I think this is a pretty safe position. In fact, today I think all of my positions are quite safe. I'm not closing any of them. I'm literally going to let them all expire, but we're going to go through each one of them one by one just to see how much money I made. So the current market value of this Apple share is $2. The book value is the value that I originally collected when I sold this. So I collected $152. So right now my realized gain, if I bought it out for $2, would be $150. Now the reason I don't buy it out is because I'd have to pay the transactional fee. It would cost me around $8 Canadian to buy out this position. So even though I'd be buying it out for $2, my commission would be another $8. It cost me $10 to close this position. If I let it expire, it's going to cost me nothing. Let's look at the next position. So this is a call on Celgene. Now this Celgene position, I actually am playing both sides of it. So I have a put that corresponds with this, but the put is at a later date. So on Monday, I will be reopening this call position at potentially a higher price or lower. So let's look at the price right now. It's at $78. I bet that I'm going to be reopening this around the $85 strike price again for July expiration. So we'll move it 1 month out once this expires. So right now, if I wanted to buy it out, it would be $3 plus my commission fee of $8. And originally I sold it and collected $40. So that will be my total profit, $40.46 that I've made on this trade in the last month. Now let's look at Costco. So it's a put. So the puts, I want the share price to be above $190. Click on trade. You can see the strike price is $197, and this is well out of the money. And I've collected a fairly good gain on this. I've collected $542. Now let's look at Cisco. So you'll notice there's two positions. I've got a call and a put, which means I want it to fall in between these. I want it to be below the call at $50 and above the put at $43. So if we click on either of these, it's going to bring up the current price. Current price is $44, which is above 43 and below 50. So both of these are going to expire worthless, and I would have collected the maximum profit available on these two trades that I placed last month. Now EWZ, this one's quite unique. It's showing that I've made a huge amount of money. This is quite misleading because I actually had some puts against EWZ, and I've been managing this trade for quite a while, so I'm actually quite happy to get out of this trade. I'm excited that it's going to be closing in an hour, and this profit is not realistic at all. So we're looking at a $32 price, and I wanted it to be below $38 for this particular position. So although in my account today it looks like I'm claiming a $4,600 credit, that's actually quite false. I've actually made only a couple $100 over this over about an 18-month period. Now Intel, again, I put this on just 1 month ago. In fact, I'll just pull up my sheet here so we can take a look. So on May 7th, the stock was trading at $53.48, and I opened this strangle. So I sold to open 2 calls that would expire June 15th for $57.50, and I sold to open 2 puts that expired June 15th of $49. So at that time, when it was at $53.48, I wanted it to expire between $57.50 and $49. For that, I collected some premium. I collected $97 and $83. That's after my commission fees. So I collected about $180 on a position that cost me about $1,800 in margin. Now, of course, that's margin, so I have to have that cash in my account, but I'm not actually spending that cash. It just needs to be available in order for me to put on these positions. So I've got a cash amount sitting there of around, I think it worked out to $1,870 in this particular case, and then I sold those 2 options against it, the call and the put, and I was able to collect $180. So in this case, I made about a 10%, just under a 10% return in a single month. $1,800 of margin, not actually invested, but just sitting there kind of earmarked for it. And then my realized gains on selling those of about $180. So that's the way I like these trades to go through in general. So we can look at that Intel. So you can see the 2 positions. I'm -2 on both. 57.50. It's a call, so it needs to be below that. It needs to be above the put at 49. And if we click on this, it's currently at 55.30. So it's bang on. It's right in between that strategy. Rubbermaid, again, this is only one side of the position. I actually have a put at $30, so this is an inverted strangle, and I'm managing that currently. So I will reopen this call likely at $28 on Monday on market open. This month I've collected a $43 credit. Now looking at Starbucks today, I've got this $60 call and three positions. So if we click on this, we want the price to be below $60, and the price is $56.98, exactly where we want it to be. Now the put, XBI, $95. We want it to be above $95 for a $0 expiration, and it is $97.30, which is $2 above the 95. That means all of these options today, I'm just gonna let them expire, because when they do, all of that margin will be released back into my account, and then I'm able to sell new positions on Monday morning. It's kind of as simple as it is. There's management that goes into some of these trades, but a lot of them we just put them on, and then next month we just let them expire. So I'm going to be doing some videos very, very soon on actually opening up these positions, but for now I just want to give you guys a glimpse into what's going on and to give you more of an idea of how these options are generating money on a monthly basis. That's it for today. Let's get rich together. See you very soon.